U.S. natural gas futures ended the week with strong momentum, breaking above the $3.50 resistance level and closing Friday sharply higher. The June contract posted its first weekly gain since late March, driven by bullish technical indicators and renewed hopes for progress in U.S.-China trade talks, even as traders dismissed a bearish storage report. Thursday's EIA release showed a 107 billion cubic feet injection for the week ending April 25, slightly below the 109 billion cubic feet consensus but nearly double the 5-year average of 58 billion cubic feet. This brings storage levels to 0.2% above the seasonal norm. Friday's rally was also supported by improved sentiment in broader markets, fueled by reports of possible renewed trade negotiations between the U.S. and China, which sparked a risk-on tone across multiple asset classes. Meanwhile, Baker Hughes reported a modest rise in gas-directed drilling activity, with the rig count increasing by 2 to 101. Although still low by historical standards, this uptick suggests that producers may be responding to recent price strength. Short-term weather forecasts, however, offer limited support. The May outlook indicates light national demand, with much of the country expected to see mild temperatures in the 60s to 80s, and cooler 50s in parts of the Midwest and Plains. While hotter weather in the far south may boost local cooling demand, overall consumption is expected to stay muted in the coming week. In its April short-term energy outlook, the EIA projected that natural gas prices will rise from the current $4 to $5 by the end of the year. It also forecast a 4% increase in total U.S. natural gas demand in 2025 compared to 2024, driven primarily by a 3.3 billion cubic feet per day increase in U.S. LNG exports. The EIA noted that domestic natural gas production has remained flat over the past year, based on the trailing 12-month average. This stagnation is partly due to low prices, dropping below $2 for the first time since the COVID period, which prompted producers to shut in wells and reduce rig activity. As a result, the EIA indicated that production growth is insufficient to keep pace with rising LNG export demand. Nevertheless, in recent years, the EIA has struggled to demonstrate the reliability of its forecasts. Meanwhile, the American Gas Association offered a different perspective in its latest outlook, highlighting continued production growth, especially in the Northeast and Texas. As shown in the chart, current production has averaged about 5 billion cubic feet per day above the 2-year average, which is more than enough to cover the EIA's projected 3.3 billion cubic feet per day increase in U.S. LNG exports. Meanwhile, the latest report from the Baker Institute added further skepticism to the bullish LNG outlook, noting that a license to export LNG does not guarantee actual exports. Instead, it merely grants the option to proceed if the opportunity is economically viable. In other words, unless a project can deliver sufficient returns across the entire supply chain, it won't move forward. This dynamic has played out before. During the early 2000s, more than 45 licensed LNG import terminals never materialized because market conditions failed to justify the investment. The outlook for LNG markets has shifted due to ongoing concerns about a potential global economic slowdown. Overall, the market is caught between bullish technical momentum and a bearish fundamental backdrop. Improving risk sentiment and strong chart signals support a short-term upside, but weak weather-driven demand and resistance near key levels at $3.65 and $3.80 could cap further gains unless fundamentals start to align more clearly with the rally. Still, while momentum may push prices higher for now, it won't last forever. The growing storage surplus is likely to temper the current optimism as bearish fundamentals gradually reassert control and restore market balance. Thank you for watching. See you in the next one.